Good evening again, and thank you for joining us tonight. Today's presentation will be on trust deed investing, how to build wealth with integrity, dedication, and transparency. My name is Dmitry Fomichenko. I will be your host today. I'm the founder and president of Sense Financial Services. Just a quick disclaimer that we are not a fiduciary and we do not provide legal, tax, investment, or accounting advice. If you need help in those areas, you should contact a qualified professional. Just quickly about Sense Financial. For those of you that are not familiar, I see a number of clients joining us. So thank you. It's good to see your names there. But we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. We've been serving clients since 2010. Our clients love us. We have hundreds of five-star reviews on Google, Better Business Bureau, Yelp, LinkedIn, and Bigger Pockets. We assisted over 3,000 clients establish over 4,000 self-directed retirement plans. And most of our business comes through referrals. We don't do marketing or advertising. It's mainly by word of mouth. So just a little bit about us. Our mission as a company is to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And I know that all of you work hard for your money. And the goal should be for your money to work hard for you. And one of the aspects of that is a retirement account, because most of you probably have retirement accounts of some sort. So we want to make sure that your money is working hard for you. And that's actually where tonight's presentation is very topical, and it fits into this idea of your money working hard for you. So you can use your retirement account to invest in trust deeds. I'm doing that myself personally. And so your money can work hard for you. And we want to come along and help you in this process. But just quickly, the benefits of a self-directed IRA and self-directed solo 401k, that these types of accounts allow you to invest in alternative assets, meaning that you can achieve true diversification, because with conventional IRA or 401k, your investment options are limited. Your retirement account in a quote-unquote IRA prison, because if you have an IRA at Vanguard, for example, or Fidelity, those institutions, they have the walls, and you cannot go outside of those walls as far as your investment options. But you can do so. We can help you remove those walls, so you can go wherever you want as far as investing by utilizing a self-directed IRA or 401k. Investment returns are tax deferred when you use traditional retirement account, traditional IRA, or 401k. And if you're utilizing a Roth account, then those returns are tax-free, and qualified distributions are tax-free. That can be very, very powerful. You can also leverage your funds using the non-recourse loans. For those that are interested in actually buying physical real estate, I've done that myself. It's very powerful. We enable our clients to have checkbook control. Essentially, you can bypass the middleman, bypass the custodian, or completely eliminate the custodian in the case of a solo 401k. And you can literally have a checking account for your retirement funds, and you can make those investments as simple and as quickly as writing a check. Solo 401k, for those who are eligible, is a great tax shelter. You can contribute up to $73,000 of your self-employed or business earnings. And by doing so, you're significantly reducing your tax liability, or even double that if you and your spouse are together in the business. There's a lot of things you can do with your self-directed IRA, but there is a few things that you cannot do. And IRS actually doesn't have a list of allowed investments, but IRS does have this prohibited transaction rules that are spelled out in the Internal Revenue Code section 4975. And it says that your IRA cannot be invested in collectibles and life insurance contracts. On top of that, your qualified retirement plan, IRA or 401k, cannot engage in any transaction with disqualified person. And disqualified person is yourself, your spouse, your kids, grandkids, and their spouses, your parents and grandparents, and any entity that these individuals own. So there's a few limitations, but other than that, you have a lot of freedom to invest. This cartoon, the credit for this goes to my young daughter many years ago, and she helped me with this, and I think it makes a great point. A man and a woman standing with man holding a basket, and bottom is fell off, and all the eggs are broken. And wife says that she thought that their investments were diversified. And the truth is that if you're just in one asset class, whether it's a stock market or something else, you don't have a true diversification. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. There's a lot of wisdom in that, and you can accomplish true diversification with truly self-directed retirement accounts, such as self-directed IRA or self-directed solo 401k. Unlimited investment options means that you can invest in physical real estate, residential or commercial, single family or multifamily. You can invest in tax liens and trust deeds. You can invest in precious metals such as gold and silver. You can invest in cryptocurrency. You can invest in private lending. You can be a bank. And that's what we're going to be talking about today, how you can use your IRA or 401k and be the bank. You can actually be the lender. With this, I'm going to transition into tonight's presentation. And our presenter tonight is going to be Jeff Lamotte. He's a Vice President of Val-Chris Investments. He will help you learn more about trust deed investing and how to build wealth with integrity, dedication, and transparency. So let me just quickly introduce him. Jeff began his experience in financial services industry while attending school at the University of California, Irvine. After graduating, he started to work as account executive at Val-Chris Investments. And after a few years with the firm, he became one of the top producers and personally helped Val-Chris reach #1 on the Scotsman Guide type private lender list in California. So way to go, Jeff. He became a licensed real estate agent in 2011, California licensed real estate broker in 2012, and then acquired his NMLS license a few years later. So with over a decade of experience in loan origination and funding, Jeff quickly learned the skills which are necessary to originate, underwrite, and place private loans in the most effective ways possible. So Jeff will be covering a lot of information today. So if there's any questions that you guys have for Jeff, I do encourage you to use a Q&A section there you'll see in the corner of your screen, and you can type your questions there, and we will have time at the end to go over your questions and make sure that all questions are answered. So with this, Jeff, go ahead and take it away.
Thank you, Dimitri. And as Dimitri said, my name is Jeff Lamotte. I'm with Val-Chris Investments. I am the vice president and one of the partners here, and I have been with the firm since 2009. My goal today is to really teach you about trustee investing as a whole, kind of what it is, where it comes from, and about Val-Chris Investments as well, and sort of how we can assist in making sure that you are the most educated, to make sure you get the most education possible when it comes to purchasing trust deeds. So with that, I'll hop into it. And also, as he said, please use the Q&A section as much as possible. You'll have lots of questions as I go through this. This way, at the end of the session, I can make sure to answer all of your questions. I'll also include my contact information as well, so that way if you have further questions after the fact, I'm more than happy to help. So to start, I'll go in a little bit about Val-Chris Investments. We've been around since 1975, believe it or not. Definitely one of the longest in our space. And I'm so sorry if my Slack is popping up there. Definitely one of the longest in our space. It's rare to see that in private money. We've always only ever done private or hard money loans. So while a lot of mortgage lenders out there will jump back and forth and whether they're doing conventional or whether they're doing non-QM, we simply focus on what we're good at, and that is private or hard money loans, as they're often referred to. Since our inception, we have funded well over $3 billion in loan fundings, which is a staggeringly large number, and I have to remind myself of that every time I see it. Most of that's probably within the last 10 or 15 years or so, as we've kind of started to expand and grow our footprint quite a bit. But as I mentioned, we stick with hard money loans because we believe if you're good with it, stick with it, and you'll be one of the best in the market. Right now, we are mostly active in California. In the last couple of years, we've also expanded to 7 other states as well. So we are currently active in 8 states total. Types of products. So I'm going to go over the types of products that we offer, and then from there, I'll kind of explain more as to what it means when you're an investor side of it, because this is really the products that we offer to our clients when they come to us for loans before it gets funded by the private investor who is then investing in trust deeds. So what Val-Chris does is as a private lender, we offer first, second, and third position loans to people that are secured by real estate. Everything we do is secured by real estate in some sense, whether it's multi-units, residential, commercial, industrial, or land. We offer bridge loans. So someone selling their house and to buy another house and the money needs to go escrow to escrow, we can do those types of things. We cross-collateralize loans. So we cross-collateralize properties in order to do one loan, like a blanket loan. We do loans for purchase transactions, refinance, whether it's rate and term or even if it's cash out. Those are our most popular, is going to be a typical cash out refinance for business or investment reasons. Loan terms. So if a borrower comes to us, these are the terms they're going to see. Typically, our loan amounts are going to be anywhere from $30,000, and we funded loans as large as $6-7 million. And all of these loans are funded with Val-Chris money, which is then sold off to our private investors. Typically, the terms on these loans are 1 to 3 years with 3 to 6 month prepayment penalties. A prepayment penalty is sort of what it sounds like. So as a private investor, you are buying a note and you want to make sure that you're not going to get paid off in 2 days, 3 days, a week, 2 weeks, where essentially you do your due diligence, you review a file, and you invest your money, and then you get paid off in a week. It's not a very fun feeling. So what we do essentially to combat that is we have something called a prepayment penalty on most of our loans. And that is where if the borrower pays more than 20% of the principal balance or pays off the loan completely in the first 3 to 6 months, depending on the length of it, they will actually pay a penalty on that money to you as the investor to essentially reimburse you for the work of having to invest your money into the property and getting paid off quicker than you would have liked. On most purchase transactions, so whenever a borrower comes to us and says, hey, I want to buy this property, we will typically go up to 65% of that appraised value or that purchase price, whatever is lower. So we're on the more conservative side of it. So if a property appraises for $500,000, but the purchase price is $550,000, we will lend them 65% of that $500,000, and they'll have to make up the difference with their own cash. On a refinance transaction, we will typically go up to 60% at the absolute most. There's an asterisk there because we have gone a little bit above that depending on the deal specifically, but for the most part, 60% is the limit. We believe that these limits are a conservative way to make sure that your principal is protected in the event of any sort of notice of default or foreclosure process. Our funding volume. So we typically fund between 75 and 105 loans per month. So it's a large volume for a private lender, especially one that is on the smaller side like we are. I say smaller just because we have about 15 employees at our office here in Irvine. So not a huge company by any means, but our volume I think is much larger than pretty much all of our competitors that are in our space. All of our loans are funded by Val-Chris Investments with our own capital. And then, as I mentioned, we sell them off to private investors like myself, like you, like Dimitri, or anyone else who is looking to purchase notes. What is trust deed investing? So As the investor, you are coming in on the other side to purchase the notes of what I just mentioned. So if a borrower comes to us and borrows $100,000 and their property is worth $200,000 and say they have a rate of 10%, we offer them that loan. We offer the terms. We offer we do the appraisal. We do the due diligence, and we essentially say, okay, we'll offer you this loan at these terms. And then when that loan funds, what happens is we go to our investors and say, hey, dear investor, would you like to buy this loan? It's 50% loan to value, meaning 100,000 on 200,000. You're going to net, say, 10% or whatever the rate is. And so that's what it is. So when a loan is given, secured by real estate, is the short answer of it, frankly. The loan itself will be recorded with the county recorder with the deed of trust. So whether you are in first position, second position, third position, whatever loan that you are interested in buying, you will actually be recorded so that you will be listed as a beneficiary on title, depending on the way that you hold title. So if Joe Smith buys a note from us in first position, and if you were to pull title on his house, you would see Joe Smith in first position on title, just as you would if you were a bank or anything else. Sorry, let me see if I can turn off. Oh, there we go. You would see yourself listed on title. And so many investors prefer this just simply because it's a great way to make sure that you are of record. And if anything occurs ever on the property, you are listed as beneficiary and you are a secured investor. So the investor or beneficiary is listed on title as the lien holder, similar to as a bank. The borrower makes monthly payments to the servicer of the loan until it matures. At that time, they either pay off, refinance, or in some cases, request to extend their loan. The borrower will make monthly payments to the servicer. That is going to be Val-Chris Investments. We understand that you as an investor are buying a note as an investment, but you are not in the professional field of making loans yourselves. So it's our duty to then, send out payment statements to the borrower, just as a typical bank would, just as you would pay your payments to your mortgage lender. We collect the payments and then we send them off to our investors as they collect their monthly interest checks. When the loan matures, as it mentions, they either pay us off with cash if they have it, or they sell the property, or they refinance into another loan, or also, as it mentions, if they request to extend their loan, they can do that with the approval of the lender or the investor that owns the loan itself. Loan amounts are based on the LTV and an appraisal. So LTV is loan to value. It's a simple way for us to determine what we consider the risk associated with the loan. The higher the loan to value, the quote unquote more risky it can be, depending on how high it goes. So when I use the example of 100,000 based on 200,000, that's 50% loan to value because we're lending them 50% of the property value. And as it mentions, Val-Chris Investments services the loan. Benefits of servicing. So some of our investors don't use us to service, but in my opinion, the benefit is there and it's worth it. We have a full-time servicing department, so that are essentially dedicated to servicing. We have 5 full-time employees, and this is all they do. So if you call our office or a borrower calls our office, you get a live person on the phone. You're not going to sit on hold forever. You're going to talk to me. You're going to talk to someone else in the department to make sure that you get all your questions answered appropriately. Collect payments is the most important thing we do. That's how you get your payments. We collect payments. We ACH them to our investors. Even delinquent payers, we send out notices to make sure that they know they need to send us payments. Late notices, non-payment follow-up. It's a tough job. Someone's got to do it. We're happy to do it, and it saves you the phone call and sending out notices yourself. Notices of default and foreclosure. So the way that you protect your principal when you're investing in trust deeds is you file a notice of default if they stop making payments after a certain amount of time. That essentially is a public record filing stating that we are going to foreclose on that property unless they bring our loan current. It's rare. It doesn't happen all the time, but it does happen. And so that's where the loan to value comes into play when it comes to how safe or conservative you want to be. The lower the loan to value, the more equity cushion is there. That way, if you ever have to foreclose on a property, there's plenty of space there to make sure that you're made whole and that all of your principal and interest is collected. We do all that for you. We hold your hand through the entire process. It's a very passive type of situation where we essentially handle it and just keep you apprised and check in with you during the process. Among other things, we handle the tax service, we handle payoff demands, and everything else that a loan servicer would typically do. And we've been doing it for many, many years, and I think we're pretty good at it at this point. So people always ask me, why would a borrower come and get a hard money loan? Our rates are higher, the fees are more expensive than a typical mortgage loan, and it's a valid question, but we offer a product that not a lot of people out there offer, not a lot of companies out there offer either. When you're a borrower, they're a typical self-employed person, as Dimitri, I'm sure, can explain. It's tougher to get a loan. You can't always verify your income. You can't always verify your assets. You may have more write-offs than most people do. And a bank will want to verify everything, as I'm sure all of you know. They want to verify your income, your assets. They want to see years of bank statements. They want to see a level of consistency to make them feel comfortable. We don't need that. Since we're an equity-based lender, we're not as concerned with the bank statements. We're not as concerned with the borrower showing us a W-2 statement or their tax returns. We're more concerned with the equity of the property because that is our security. But other issues are they own too many rentals, and too many rentals, their debt to income could be off, their ratios could be off where a bank won't qualify them. Their income is hard to show or cannot be documented is another big one. Poor credit. Frankly, with most banks, they want to see 660 plus. It goes up and down depending on the bank itself, but usually that's the ballpark of where it needs to be. And if you're below that, you need to look at other avenues, and that's where we come into play. Speed is a priority. So this is probably the biggest reason people come to us. We close loans in typically 7 to 10 business days, whereas most banks will be about 60 to 90 days, depending on the deal itself. Speed is a priority when it comes to short sales, foreclosures, and other unique opportunities where an investor might be able to scoop up a property quickly at a short sale or foreclosure sale. And to do so, you typically need cash, which is tough to do. With a private money loan, you can look like a cash buyer. And so they come to us for those reasons. Once they get the property, they'll usually go and refinance within 3 to 6 months, depending on the loan they got from us. And that way they can get back into a longer term, lower interest rate loan. Doing so allows them to acquire it quickly, and then, like I said, transfer into a long-term loan rather easily after the fact, rather than stressing about it when they're trying to acquire the property. Trusted investing versus other investment vehicles. So trusted investing is specifically secured by real estate. It will always have some sort of piece of real estate connected to it, securing your investment. It's not going to fluctuate like a typical market would fluctuate. It's going to be based off the real estate that you lend on. You have more control over the deal, the location, and loan to value. We sell individual notes. There's also something called a mortgage fund or a debt fund, where you can essentially place money into a mortgage fund and you get payments just quarterly based on the performance of the fund itself. What we do is we actually sell the note on each specific individual deal. So if you buy a loan from Val-Chris Investments, you know what you're buying. You know the address, you have an appraisal, you have a loan application from the borrower, a credit application, you've seen title, you've seen mortgage statements, you've seen everything related specifically to the loan that you are purchasing from us. And that also means you know exactly where the location is and you know exactly what the loan to value is. You get monthly payments. This isn't like the stock market where you're hoping to get some dividends, or you might wait till it grows in value and then try and sell it and pay capital gains at the time. You get monthly payments. So with us, if you buy a loan and it's $100,000 at 12%, you're going to get $1,000 a month from us, and it's interest only. So at the end of the loan, you're then going to get your $100,000 back. Ability to diversify your funds over several loans. So as Dimitri said, diversification is key. Diversifying it over different asset classes is even more important. And if you're able to diversify within each class, I think it's even better. So if you have money in the stock market, you have money in your 401k, you have money in crypto, you have money wherever it is, and then you have a separate piece set aside for purchasing trust deeds, well, you can have 4, 5, 6, 7 different trust deeds within that piece of your portfolio. And those 4, 5, 6, 7 pieces will be broken up over that many different properties with that many different borrowers. If one person stops paying, it doesn't affect your other loans whatsoever. So even if you're dealing with a situation where one borrower is a couple months behind, and even if they bring it current eventually, you have 6 others that are paying just fine, that are not linked together. Not linked to the market or Twitter wars. That's probably my favorite one on here. someone going on Twitter and getting crazy to, make the market stressed out and cause stock values to drop. That doesn't affect this. Your loan is based on the property that you lent on. Assuming you're comfortable with that loan to value, then you're fine. So about us: integrity, dedication, and transparency. So what we pride ourselves on, since we've been around for so long, is the ability to talk to our investors in a meaningful way and explain what we do, how we do it, and then to essentially put our money where our mouth is. And I'll explain over the next couple of slides, as you'll see. But as a private company and a private servicer, we service over 1,000 loans ongoing per year, and it goes up. I think we're around 1,300 right now, 1,400 or so. We willingly share that information. We share our notice of default information, the percentage of properties that are reverting back to our lenders, and everything else. So you'll be seeing that here shortly, and we take pride in that, and we enjoy doing it. Loan servicing in-house. So as I mentioned previously, all the services, including with loan servicing, it's important because if you're going to buy a loan from a private money company, if they don't service the note, they don't know what happens to that loan after the fact. For all they know, they're funding a bad loan, and it goes off, and then the borrower stops making payments, or something happens, and it's a huge pain, and you got to deal with it. That lender has no idea what's happening. Since we service all of our own loans, we keep track of our borrowers. We take pride knowing that we make good loans, that our investor can call us and ask us questions directly, and we have our thumb directly on the pulse of what is occurring with that specific transaction. Decades of experience. My partner, Chris Bolter, he's been doing this since the early 80s. As Dimitri mentioned, I've been doing this since 2009. We have our in-house legal and head of loan servicing has been doing this for about 35 years. So quite a bit of experience under one roof. And I think that's one of the things that makes us more successful. Annual investor event. So we have an annual investor event. COVID put a stop to this for a couple of years, but I believe Dimitri was there. We did one earlier this year over here at Andres in Irvine, which is right next to our office. And we had over 140 people, 140 of our investors show up. It was a great time. I gave a presentation. We had one of our attorneys speak on bankruptcies and other challenges in the market, ways that we help navigate if there's ever a problem. And it was a good way to put a face to the name and actually meet our investors, shake some hands, and have food, drinks, and had a good night to kind of go over everything as a company and in the market as a whole. Resource for investors, whether you're brand new or have decades of experience. This is something we also pride ourselves on, is we are a source of education. I like it when investors call me and ask me questions and kind of learn more about the industry as a whole. It's not something where you're blindly, making moves. It's nice to know when investors are understanding what they're purchasing, asking me what they're purchasing, why we're doing what we're doing, the decisions we're making, the rates we're selling, all that kind of stuff. So here's our 3-year performance: 2020, 2021, 22, 22. Since those are our completed years, that's what we have so far. So I'll kind of go through this briefly and sort of explain as I go. So in 2020, we touched over 1,000 loans. When I say touched, meaning we serviced over 1,000 loans in total for that year. Of those 1,000 loans that we serviced, 7% of those had a notice of default that was filed. When a notice of default is filed, it's essentially, as I mentioned, putting the borrower on notice that, hey, we are going to foreclose on your property should you not make payments and bring us current. Of the 7% that were filed, of the 1,000, only 9 of those actually went to trustee sale, which means that goes all the way to have a public auction where an auctioneer is up there and he's on the court steps and he's taking bids on the property itself, just like you'd see in those TV shows online, or TV shows where people go and bid on properties. Of the 9 that went to sale, only 3 of those reverted back to our lenders. What that means is, of the over 1,000 loans that we funded, 3 of those reverted back to the lender. So if you invested in a loan that was $100,000 and it was, say, worth $200,000 at the time when you bought it, and that borrower stopped making payments, say on month 7, that means you collected 6 months of payments, interest only. Month 7, they disappeared. We had to file a notice of default. We went through publication, which is when you set the date and the prices, and it goes to sale, and then no one bid on that property. That property then reverts back to you. What that means is now you're the owner of that property. So you keep any interest that you've been paid, and then now you own that property. Now at that time, you can either rent it out, you can fix it up yourself and you can sell it, you can do whatever you want to do with it. You're the owner of it. Now, at the end of the day, what I tell people is never invest in a trustee that worst case scenario, you wouldn't want to own that property for what your investment is. So if you're buying a deal that's, like I mentioned, 100,000 on 200,000 for 50% loan to value, would you buy that property for 50 cents on the dollar? So keep that in the back of your head when you're looking at these loans. Worst case scenario, you own this thing. Would that be something that you'd be okay with? 2021, we serviced over 1,100 loans. 5.3% of those had a notice of default filed. Of that 5.3%, only 3 of those went to trustee sale. Of those 3 that went to trustee sale, every single one of them went to a third-party bidder, and our lender got paid in full with their principal plus all their interest. 2022, over 1,300 loans serviced. 8.4% of those had a notice of default filed. Of the 8.4% where an NOD was filed, only 9 of those loans went to trustee sale. Of those 9, 7 reverted back to our lenders. So you can see we're open with the stats. Again, these are loans that we originate, that we service, our investors are funding, and we take pride in that, and we make sure that our investors know that this is what we're doing. So that way you guys feel more comfortable when you're talking to us, when you're buying loans from us, and we're more than happy to share anything about the company to make you guys feel better. Risk management. So risk management, in my opinion, it's twofold when it comes to purchasing notes, because you have us as the company itself that is selling you the note. We do our own underwriting. We do our own review. We do our own appraisal. We have our entire system in place that touches many different people and has many different steps to make sure that we're offering the highest quality loans possible. But also, it's you. What are you buying? What makes you comfortable? What types of loans are you looking for when you're looking to invest your money? Trustee investing is unique because you have more control over the loans that you purchase. However, everyone has a different risk profile, and as it mentions, not all investors are created equal. While we do our own underwriting, it's important that each of you have your own idea of what's important when you're purchasing a loan. Geography. This is probably the most important when it comes to trustee investing outside of the loan to value. Geography is something to me where if you're going to buy a loan, you want to buy it in an area that you're familiar or comfortable with. If you live in Southern California and you've never been to Humboldt County in your life, I would say probably don't buy a loan up in Humboldt County for that reason. If you live in Orange County your entire life and you grew up in Irvine and you're buying a loan on a property in Tustin, odds are that's a great loan for you. You know the area, you are comfortable with. If you want to drive by the property and see it yourself, you can do that. So it adds a little more comfort, but also you understand the asset class better than you would something that isn't in your local geography. Lien positions. Lien positions. So first trust deeds are typically more secure, while second trust deeds offer a higher yield. So when I talk about lien position, it's essentially that. It's the position that you are on title when it comes to getting paid off if there's ever an issue. So if you go to buy a house right now and you use Wells Fargo to get your loan, Wells Fargo will be in first position on title. Now, if you go back to Wells Fargo and you were to get a HELOC, that HELOC would be in second position on title. So if you ever got foreclosed on, the bank's first would be paid off first, and then anything left over would then go towards the HELOC. So that's essentially the same with trustee investing. You are purchasing a note in whatever position you are purchasing it. So first position loans are going to be more secure because you're the first one to get paid. Second position loans will be more risky because you're second to get paid, but they do offer a higher yield. They're for two different investors, in my opinion. We have plenty of investors who like that higher yield second trust deed. They like that risk factor. They don't mind foreclosing. They don't mind taking a property back. Maybe they do it professionally. Maybe they're property managers, whatever it is. First trust deeds are more secure. It's much more passive. You know that you're first to get paid. It's a much simpler situation. I would say most investors are looking for first trust deeds for that reason. When it comes to property types, this is also a situation where you need to look at what is important to you. If you have experience in multifamily, in commercial from your career or in previous ventures, whatever it is, and you like those, great. You want to buy those loans? I love it. More power to you. That's fantastic. We offer them and we can help you through them as well. If you're not, and you're a typical investor who likes to buy loans and you want it to be as passive as possible, I would look for residential type properties. Most of our investors stick to residential. They look for those cookie cutter SFRs and a neighborhood with an HOA or a PUD, and It looks like every other house, but that means also there's many other comps, and it fits well into the neighborhood. So stick with what you are comfortable in. Don't venture out. Don't go buy a loan on raw land if you've never done that in your life or you know nothing about land. So stick with what you're good at. Fractionalizing. You don't need to buy the entire loan. So if you see a loan that you like for $100,000, $200,000, whatever it is, and you have 40, 50 grand, you can buy a piece of that loan so that you are able to participate without having to actually fund the entire thing yourself. What happens is then we would place you with other individual investors who are looking at the same loan. So if there's a loan for $200,000 and you have 50, we might break it up into 4 pieces of $50,000. Now, what happens is then all of you own that note as tenants in common, and all of you are listed on title as the beneficiaries. Navigating the industry. So a little bit more about Val-Chris here. So the industry itself is constantly changing. As I'm sure all of you know, with the market swings over the last 30 years, there's been a few of them, and we're still around. We've been thriving ever since. It's because we're dedicated to what we do. We are dedicated to just private lending. We are members of multiple industry organizations to stay on top of the regulatory and market changes because of that. The CMA is the California Mortgage Association, not the Country Music Awards. I wish, but no, the California Mortgage Association. It's a lot less entertaining, but it's also very good as far as information goes. And it's one of the biggest factors is to making sure that we're always on top of our game. The United Trustee Association and obviously the Better Business Bureau. We stay actively involved in these organizations so that we have a close working relationship with, honestly, many of our competitors, because we found that having that close-knit relationship with our competitors helps everyone navigate the industry in a much safer manner, since we're all kind of looking out for each other. Feel free to check us out online as well. Google reviews, we have 119 of them as of when I put this together, with a 4.6 rating, 4.8 out of 5 stars on Facebook. Over the 48 years of operation, we have over 3,000 investors right now. I checked this morning. We have over 3,000 investors that have signed up with us over the years. I want to say right now we have roughly 1,200 that are active. We have grandkids investing with us whose grandparents started with us over 40 years ago. So it's cool to see that family line and to work with so many different types of investors. Just as Dimitri mentioned with him, a lot of ours are referral based. So we don't actually advertise for investors for the most part. Most of our advertising goes towards mortgage brokers for getting the loans in-house. Most of our investor referrals come from other investors that are currently investing with us. And we are continually growing. So we like the fact that our employees work with us, they stay with us, that many have been here for 10 plus years, some even longer than that. And we're continually adding to our team. We're expanding in different states that we're able to lend in to make sure that we keep offering quality loans for our investors. And we'll be doing this for a lot longer. So if you want to get started, I know I went over a lot of information on this webinar here, but I'm more than happy to talk with you individually. Feel free to shoot me an email. That's the best way to do it, because then I can schedule a call with you and put it on my calendar, and that way you have all my attention. We can go through your situation. You can answer any questions that you have, and we can kind of go through the entire process in more depth and help out where we can. At that time, I'll send you an email with some paperwork to complete, and it's best to speak with Dimitri beforehand if you can, because then you go into that call understanding how you're going to hold title. Whether it's you personally, husband and wife as joint tenants, whether it's your solo 401k or your IRA, these are all things that you want to know, because that's how you're going to hold title, that's how you're going to fund the loan, and the implications when it comes to taxes or other things is huge. So it's good to have that in mind. Once the paperwork is complete, you'll start to get our weekly list of available trust deeds twice a week. So the way we work is every Tuesday and Thursday, you get an email from us with our available trust deeds, and you simply reply back to that email with what you're interested in purchasing. So if you like a loan for, like I said earlier, $100,000 in, say, Los Angeles, you would reply back and say, hey, Jeff, I'm interested in this loan. I would send you the package for review, which is going to include a loan application, credit report, appraisal, preliminary title report, a summary sheet. And then from there, you would determine whether or not you want to invest in that loan. So it's as simple as that. It can get a little more complicated depending on the unique situation, but we're happy to help you navigate through it. And we hope that you reach out with any questions and kind of start the process. So feel free to contact me anytime. There's my information right there. To get started, email is usually best so we can get something scheduled, and then I can make sure to give you my full attention. And thank you so much for your time. I greatly appreciate everyone for hopping on and listening to me talk tonight.
Jeff, thanks so much for great information this evening. We do have a few questions here. If you guys can think of something else that you want to ask, now is the time. So go ahead and type your question and we'll get to that. But first one comes from James. He's asking, who handles defaulted borrower and sales process if it gets to that?
So that's us. That is Val-Chris Investments that handles that essentially. So what we do is we are as the servicer, we lead the process. Now you are still the investor. You're still the beneficiary. So at the end of the day, you still make the final call. If you reach out to us and say, hey, this guy's not making payments, I want to file a notice of default, we're going, assuming it's within our legal right to do so, meaning you haven't jumped the gun or done anything too early, we're going to follow your lead. Now, if you don't know, or you're like, I'm going to follow your lead, then we're going to do what we recommend, which is based on our time frame and based on what we've seen that we've done over the years. So we handle all that for you. We hold your hand, but obviously we take your direction and we make sure that we're doing the best possible way to protect your principal. We are your fiduciary, so that's why we're here.
Thank you. Next question. What is the average rate for your notes?
I would say for first trust deeds, the average rate is going to be between 9 and 10%. For a second trust deed, it's between 11.5 and 12.5%. Rates have gone up a little bit over the last couple of months, so it might be about a half a point higher than what I'm stating right now. It really depends on the market itself, the loan to value, and also the lien position.
Okay, thanks. Another one from Gregory, I believe. I have a self-directed IRA LLC. My entity is registered in Arizona. I must register my entity in California to invest with you.
So it depends on what the mailing address is. Now, if you buy the entire note, it's technically a state law securities situation if you're out of state. We would need to verify accreditation if the entity is out of state. Once that is done, then it's a simple process, and you basically buy the entire loan. It does get harder to fractionalize loans if you live out of state because of the securities stuff that goes along with interstate investing, but it's not unheard of. So in those situations, it'd be better just to reach out to me and we can kind of go through your unique situation and make sure that we do everything above board so that it's all documented properly.
Okay, great. And I'd like to add a little bit to that because it's a little bit in my area, talking about IRA LLC. So if the LLC is registered in Arizona and you bring this out-of-state entity in California and you lending on California property, then if state of California finds that out, then they'll be after you for their franchise tax of $800. So keep that in mind. But you can lend, I believe, Val-Chris lends in Arizona and other states, so you can lend on a property in Arizona and you'll be fine.
Correct. Yep.
Okay, another question. Can you talk about the risk of the first versus second mortgage?
Yeah. So a first, as I mentioned, you're first to get paid. So when a property goes to trustee sale, it's going to pay foreclosure fees and taxes first. So Uncle Sam always gets their money first, but then it's going to be the first position on title. So if you have a property that say it's worth $500,000 on paper because you had it appraised recently and you feel comfortable with that, and you go to sale and say the starting bid is $495, just underneath that to gain some interest. If that property sells for $550, then essentially what's going to happen if they only have that first on title, then that first will get paid back their $500,000 plus any interest that is due to them up to the sale date. So even though they haven't made payments for, say, the last 6 months, you're still accruing interest that entire time. And all of that interest will get added to what is owed to you when the property goes to sale. So say the property goes to sale, $495, there's an eligible bidder, they buy the property, but it bids up to $550, then if you owed $500, say plus $20,000 in interest, you're going to get your $520. The difference would go to the borrower or the property owner that just lost the property, and the property would go to that new buyer. It would transfer to the new buyer with a trustee's deed. Now, in that same situation, if the property, again, you have a note on there for $500, you're owed $20,000 and say back payments and interest, and then say there's a second for $100,000. Then if you're in first position, you're going to get paid off everything that you're owed, and then whatever's left over will go to the second. So the second may or may not be made whole. Now, there's a lot of intricate ways you can do this. I mean, typically, if you're in second position, you know to keep the first current so that you can file your notice of default first, so that technically you're in control of the sale. It can get a little more convoluted once you kind of go down that path, but those are the mechanics of the first and the second. So that if you're new to the game, or you're trying to figure out a much more passive or secure way to handle it, I always recommend sticking with first trust deeds, because then you're never on the hook for keeping the first current, so that you can then file your NOD and then worry about anything with the first trust deed.
Thanks, Jeff. Looks like we have a last question here. So if you guys thinking about something else, now is the time to type your question. And this one comes from Kai, who's asking, what is your fee structure, or is that already included in the interest rate?
Great question. No, so our mailer that goes out every Tuesday and Thursday, you'll see on there, it'll actually show note rate, and then it'll show net rate to investor. Note rate is what the borrower is paying. That is what the note rate is. Net rate is what you are going to net as the investor. It's always going to be 1% less. So we charge 1% for our servicing fee. So if the note rate is 12% per year, you're going to net 11% per year. As the borrower makes payments monthly, we take out our servicing fee from that payment, and then we send you the difference. So you're not writing me a check for your servicing fee. It's not like a big lump sum that comes out. It's not 1% per month. It's 1% per year. It comes out of their monthly payment. So the check will be netted out and then sent to you via ACH, and that's how you're going to collect your payments.
Thanks, Jeff. We got one more. What is the criteria for lending do you use?
I'm sorry, say it one more time.
What is the criteria for lending that you use?
I don't quite understand. I'm sorry.
I think maybe what they're trying to ask is how do you, when somebody wants to borrow money, what do you look before you lend them, the criteria for lending?
Okay. Yeah, no. So first thing for us is loan to value. Loan to value, as I mentioned, is key in our business. Since we're not verifying assets, we're not verifying income, we don't look at tax returns. Our security is the equity of the property. So loan to value is our biggest concern, and that is really what dictates the rate for the most part. So if someone comes to us and they want to borrow $800,000 on their property worth $1 million, I'm going to decline the loan and say I don't want to go that high. Now, if they come back and they say, okay, I want to borrow $550,000 on my property worth $1 million, then I say, okay, I'll take a look at the deal. From there, I will determine whether or not I like the property, if it's unique in any way, if it's a typical conforming property within a neighborhood that has that has similar comparables. I look at the borrower strength, so I'll check out I will look at the credit report. While I'm not verifying assets, income, that kind of stuff, I do pull a credit report. I look to see if they have a mortgage in the past, and if they did, then how did they pay on that mortgage? I look to see if they have a car payment. How did they pay on their car payment? Credit can be adversely affected by a lot of things, and I found that medical debt or student loans are the two things that probably affect people's credit the most. So you might see someone with poor credit, but then you go look at their mortgage payment history and you look at their car payment history. They're probably the two biggest things in their life, and they pay perfect. From my experience, those people, even though they have poor credit, actually are very good payers. So again, while we don't verify taxes, we don't verify assets or income, we do look at the credit. So other than loan to value, I look at credit, I look at property condition, pride of ownership. It's much more of a holistic view of the deal itself, rather than entering data into a rate sheet to see what kind of debt to income ratio they qualify for, or any sort of other ratios that might qualify or disqualify them for a loan. Ours is very much, does it make sense? Is there equity here and they need to borrow the money? Can we do it in a safe and effective way? If so, then we'll do it.
All right. Well, thank you so much, Jeff, and thank you all who attended tonight. This concludes our presentation. Again, feel free to reach out to Jeff, talk to him about potentially investing with Val-Chris. I personally have done it, and I had a great experience. I've done it for probably 10 years now, several dozen loans. And if you want to talk about self-directing your IRA or 401k, then contact our office. We'll be happy to help you. Thank you again, and have a good evening.